Hi, and welcome to our new series on the stock market. In this series, we will teach you how to properly research stock and understand the stock market. Our goal is not to shoot predictions on certain stocks, but rather arm you with information so you can make your own predictions. That said, please be cautious when investing in the stock market. Always invest at your own risk. Let's jump right in. First things first. What does a stock mean and what is the stock market? A stock, aka share, is a security that represents the ownership of a fraction of a company. If you own a stock, you own a real share in the company. As a shareholder, you are entitled to a proportion of the company's assets and profits equal to how much stock you own. You also have a right to vote on who should be the CEO, board members, etc. As a matter of fact, over the history, many CEOs were thrown out of their own companies. Steve Jobs was thrown out of Apple for a while but later returned. Jack Dorsey was kicked out of Twitter from 2008 to 2011, and many more. Stocks are traded in a stock exchange. Stock exchanges include the New York Stock Exchange, the NASDAQ, and many more. The easiest way for you to buy stocks is through an online stockbroker. After opening and funding your brokerage account, you can buy stocks through the broker's website in a matter of minutes. Popular online brokers include Fidelity, TD Ameritrade, Robinhood, and more. The brokers will take your online order and fulfill them for you in the stock exchange. There is a brokerage fee that you need to pay for the service, but nowadays, many online brokers no longer charge brokerage fees for online trades. Stay tuned as we continue our journey on how to invest in the stock market. Hi, and welcome back to our series on the stock market. When you hear that the market is up by 1% or the market is down 3%, does that mean that everyone that has money in the stock market just got richer or poorer? No. When you hear the stock market is up, it usually is referring to the Dow or the S&P 500. What's the Dow and the S&P 500? When people say the Dow, they're referring to the famous Dow Jones Industrial Average. The Dow is one of the most watched stock indexes in the world, which tracks 30 large publicly owned companies such as Apple, Boeing, Microsoft, and Coca-Cola. The S&P 500 index tracks the market capitalization of roughly 500 companies. To qualify for the index, a company must be in the United States, be worth at least $8.2 billion, and it must have at least 4 consecutive quarters of positive earnings. Recently, Tesla made headlines when they finally joined the S&P 500. There are more indexes like the Russell 1000, which tracks the 1,000 largest companies, and the NASDAQ, which tracks many tech companies and more. Let's end with a famous bet from Warren Buffett. In 2007, Warren Buffett made a $1 million bet against hedge fund manager Ted Sades that the S&P 500 index fund would outperform any basket of at least 5 hedge funds over the course of 10 years. Sades was able to choose any 5 hedge funds he wanted. The bet's time frame started in January 2008 and ended in 2017. Buffett ended up winning the bet, proving his point that the best fund to place your money over the long run is the S&P 500. Have a great day, and please come back next week for more. Hi, and welcome back to our series on the stock market. So we discussed what a stock means, how to trade a stock, and how to track the markets. This week, we will discuss how to choose and research a stock. To make it easier for traders, stocks get identified by a ticker symbol. A ticker symbol is a shortened form of the company name. For example, Walmart's ticker symbol is WMT. Facebook ticker symbol is FB, and so forth. Before buying a stock, you would want to make sure 3 things. That the company is a healthy company. That you're not paying too much for the stock. That the company has potential going forward. If the company that you buy ends up going bankrupt, then you will lose the money you invested. But even if the company is making money, you need to know which price point is a fair price point for the stock. A company could be making millions a year, but if you pay too expensive for the company's stock price, then you overpaid for a company which is really worth much less. Think of it this way. Would you buy the company if offered as a private company for sale? If I offer you my company, that imaginary earns $1 billion a year, would you buy it? Before you scream yes, you need to wait till I tell you the price. If I offer you my company for $5 billion, then you got a good deal. The company earns $1 billion a year. So after 5 years, you make back your money, and from there, going forward, I will meet you at your yacht. But what if I only want to sell you my company for $1 trillion? You will say, no way. But my company earns $1 billion a year. Who cares? I'm not paying $1 trillion for a company that makes $1 billion a year. The same is with stocks. You don't want to buy a company charging you too much money based on the earnings it produces. Next week, we will teach you some cool ratios to check out to make sure you're not overpaying for stocks. Always remember that investing in the stock market can result in losses. Invest at your own risk. Hi, and welcome back to our stock market series. Last week, we started talking about researching the price point on a stock. Let's continue with some important ratios to check out. The first one is what's known as the P/E ratio. The P/E ratio is price versus earnings. A company that has $1 billion in earnings and 100 million shares on the stock market, then the earnings per share is $10. It's $1 billion divided by 100 million shares equals $10. Now, if the stock is priced at $100 per share, then the P/E ratio for the stock would be 10, as the stock price is 10 times the earnings. If the price goes down to $70 per share, then the P/E ratio go down to 7. And so forward. A high P/E ratio means that a company's stock is overvalued, or that investors are expecting high growth in the future. Using real examples, Ford had recently a P/E of 13.93, while Tesla had recently a P/E of 625.06. Paying 10 to 20 times a company's earnings makes rational sense as long as you believe the company will be able to keep up the earnings going forward. But paying a few hundred times the company earnings usually does not make sense unless you believe that the company has such great potential that it will quadruple its current earnings so fast that it will eventually flatten out the high P/E. Let's use Amazon as an example. In 2012, Amazon had a P/E ratio of over 3,000. But with the solid success story of Amazon, they were able to bring it down and recently was just close to 50. But either way you turn it, knowing the P/E ratio is extremely important in order for you to understand what price you're paying for a stock. Always remember that investing in the stock market can result in losses. Invest at your own risk. Hi, and welcome back to the Stock Market Series. When buying stocks, you're buying a share of ownership in the company. So you may be asking, so why don't I also get a share in the earnings? The answer is that you do get it. When owning a stock, you usually get quarterly dividends. Dividends is a share of the company's earnings which they are paying out to the investors. There are some companies that pay high dividends, some pay low, and some don't pay at all. The average dividend yield on the S&P 500 is approximately 2%. Different investors have different goals. For some, high-growth stocks that have the potential for explosive gains are what they are looking for to help them earn a high return on their cash. These investors will usually not care much about dividend payments. Other investors also need current income from their investments in order to have cash to live on. High-paying dividend stocks are a great way for these investors because they offer current cash payments as well as potential that the share prices will go up in the future. With most brokerage accounts, you can set your dividends to automatically be reinvested in the stock. If your dividend payment is not high enough to buy a full share, then it will purchase a fractional share, which will turn into a full share once enough fractional shares are purchased. Always remember that investing in the stock market can result in losses. Invest at your own risk. Hi, and welcome back to our series on the stock market. This week, we will dive into analyzing a company's debt and assets. When investing in a company, you would always want to make sure that the company has a good balance sheet and enough cash flow to withstand a negative wind. Take an example like a pandemic. Things happen. Is the company healthy enough to withstand these things? If the answer is no, then you're taking a big risk if you put your money in their basket. The balance sheet of every publicly traded company lists the company's assets. For example, its factories, patents, cash in bank accounts, etc. It will also list the company's liabilities, which is money owed. and its shareholders' equity, which is basically the assets minus the liability. You can download the balance sheet and look through the numbers to make sure the company has enough current assets to cover its liabilities, and that the debt and assets are growing in the same phase. If debt is growing year over year much faster than assets, then the company has a problem worth looking into before putting your money in the slot machine. Another way to understand a company's financial position is to look at the company's liquidity ratio. A liquidity ratio above 1 shows that the company has enough assets to cover its debt. Any liquid ratio below 1 should be alarming, as it shows that the company does not have enough assets to cover its debt. In real-life examples, Apple's liquid ratio is at 1.54, showing that the company has over 150% of assets to cover its liability. But in contrast, Procter & Gamble liquid ratio is well below 1 at only 0.51, showing that Procter & Gamble is considered as an above-average leveraged company. You can easily find a company's liquid ratio by just Googling the company's name and add the words liquid ratio. It's important to note that not always is high debt bad. If the company is using its borrowed money properly to produce great returns on investments, then just the opposite, the more debt it has, the more income it can produce. But investing in a high leveraged company should be done with caution. I hope you enjoyed today's episode, and always remember that investing in the stock market can result in losses. Invest at your own risk. Welcome back to our series on the stock market. This time, let's talk about understanding a company's book value. When you hear that Google is worth $1.5 trillion, that doesn't mean that the company has assets of $1.5 trillion. That rather means that the company is valued on the stock market at $1.5 trillion. Meaning to say that if you multiply all Google stocks against the stock price, then it will reach $1.5 trillion. But this value can be easily washed away. How? If the stock tumbles. So what is a company's real value? For this, we need to explain what a company's book value is and a company's intrinsic value. A company's book value would be the company's assets minus its liabilities, meaning to say if the company would be forced to liquidate today, how much will investors be left with? Intrinsic business value is estimating how much value the company will generate in the future. Warren Buffett explains this concept this way. Assume that you spend the same amount for 2 children to go to college. The book value of each child's education would be the same. But knowing your kid's capabilities, you may value the future payoff for each kid's college education differently. They can range from 0 to many times the cost of the college bill. Neither the book value or the intrinsic value is a company's real value, but they are important pieces of information to know in order to determine if a company's stock price is mighty expensive or cheap. Always remember that investing in the stock market can result in losses. Invest at your own risk. In this final episode, we will discuss the difference between investing in the stock market or investing in cryptocurrency. When you're investing in the stock market, you're getting a share in a real company with a value that is hopefully based on real company profits, unless you choose the wrong company. Even though you may not be investing to get the profits, but you rather want the share price to go up, you're still investing in a company that has a backbone and a real reason for the stock price to go up. The reason is as an increase or potential increase in profits, which will result in more people wanting the stock as an increase in profit, gives the company more equity, more cash, and more money that will trickle down to its investors. Now, I do not understand cryptocurrency. I do not understand how it works, but neither does anybody. The fact is that after singing the song and spinning your head on how is the future of currency, very few people are buying Bitcoin to actually use them. A survey by Blockcard found a very small percent of holders of cryptocurrency actually using them for everyday transactions. What will happen in the future? I don't know, and neither do you. But what you need to think about is, do you think that cryptocurrency everyday transactions will be big enough to justify the 2.5 trillion market cap it most recently had? If the answer is yes, then your investment may have justification. But if the answer is no, then you're buying Bitcoin based on a bubble. You're buying Bitcoin to make money when it goes up. But why will it go up? Because other people will buy it in order for it to go up? But why will it go up? Because even more people will buy it in order it should go up? And that's exactly how it crashes, as when a time comes and it no longer goes up, everyone runs away as people only wanted it for that one reason that it should go up. And if it's not going up, then I do not need it anymore. So is cryptocurrency like the stock market? The answer lies in how strong you believe in crypto and its real everyday potential. I hope you enjoyed our series on the stock market. It was fun, and based on your feedback, we might do it again in the future. So let me know what you think, and make it a great day.